Is the AI bubble about to burst?
Let me break this down. The key variables here are the growth of AI company valuations, market adoption of AI technologies, and the revenue performance of those companies. We're also assuming that public sentiment and investor risk appetite will influence whether a bubble forms or bursts. Historically, tech bubbles have been marked by valuations far exceeding earnings. The dot-com bubble had price-to-earnings ratios over 100 in some cases. Right now, some AI firms are trading at high multiples, but the revenue growth in cloud AI services has been strong. Microsoft and Google reported year-over-year AI-related revenue increases of 25 to 30%. Sensitivity points include whether these growth rates continue and if investor sentiment shifts. My confidence right now is moderate. The main factors are earnings sustainability, interest rates, and hype-driven investment. In short, the question hinges on whether actual business performance can justify current high valuations.
I see a vulnerability in that framing right off the bat. The analyst leans on big tech revenue like Microsoft and Google's 25 to 30% bumps, but glosses over the frothy valuations in pure AI plays like Nvidia or smaller startups, where PS ratios are hitting 50 times or more, with profitability nowhere in sight. What if cloud growth slows as enterprises hit AI fatigue or CapEx discipline kicks in? .com had similar strong revenue narratives before the crash. Let's stress test those multiples against real-world adoption hurdles, like data bottlenecks or regulatory clamps. I'm at moderate confidence here. The analyst's view holds if big tech dominates, but pure-play AI overhyping and a recessionary turn could flip it fast.
I must weigh the competing views. The analyst provides compelling evidence of robust revenue growth in established cloud providers, suggesting genuine market adoption. However, the challenger correctly highlights the extreme valuations in pure play and startup companies, a critical vulnerability that mirrors historical bubbles. My strategic approach must therefore navigate this duality. The actionable recommendation is to pursue targeted differentiation, distinguishing between market-tested growth and speculative hype. I have moderate confidence, contingent on sustained revenue growth and monitoring for regulatory and economic shifts.
Let's pressure test this head-on, analyst and strategist. Your reliance on big tech revenue holds water with Nvidia's PS now around 20x after a sharp 2026 pullback, and forward PEs dipping to S&P levels, per recent market data. But that reset screams overextension, not strength. Headlines scream market turning on AI, with enterprise adoption slipping to 12% per census stats, 95% project failures, and warnings of ROI shortfalls by mid-year. What happens when hyperscaler CapEx hits $645 billion, but monetization flops? I'm at moderate confidence. The bubble deflates if adoption stalls further.
All right, let me address those points. First, the challenger cites enterprise adoption slipping to 12% and a 95% project failure rate. I want to be transparent. Those figures sound extreme. I need to verify current adoption surveys because the last reliable data I saw had enterprise AI adoption in the 30 to 40% range. Second, regarding NVIDIA's valuations, it's true they've come down from 50 times sales to around 20, but that still implies very high growth expectations. The hyperscaler CapEx hitting $600+ billion is a risk if monetization lags, but we need to separate hype from actual deployment. Cloud providers are reporting utilization rates that are still growing, albeit more slowly. My confidence remains moderate. It hinges on verifying enterprise adoption rates, the sustainability of hyperscaler spending, and whether pure-play AI startups can convert hype into revenue.
The verification confirms the critical duality we identified. While surveys like McKinsey's point to extremely high enterprise adoption, reaching 88% in 2026, search results also substantiate the challenger's concern about monetization. Reports cite consistently high project failure rates, with one 2026 study noting 73% failed to deliver ROI. This indicates a significant gap between deployment and measurable value. The strategic path forward must balance this paradox. The bubble isn't necessarily bursting from lack of adoption, but risks sustained deflation due to poor ROI. I maintain moderate confidence, sensitive to the disconnect between high investment and low realized value. Report confidence level moderate. The AI bubble risks sustained deflation due to the verified paradox of high enterprise adoption and low realized ROI.
The verified data now reconciles the analyst's perspective with the challenger's core critique. We see a critical duality. Enterprise adoption is indeed widespread, confirming genuine market penetration. However, this is tempered by persistently high project failure rates and low realized ROI, validating the monetization risks. Therefore, the Council converges on the assessment that the AI market is not primed for a sudden burst, but faces sustained deflationary pressure due to this critical disconnect. I have moderate confidence, as this position hinges on how quickly the market adjusts to the ROI gap and whether regulatory environments shift. Report confidence, level moderate, position the Council converges on the assessment that the AI market faces sustained deflationary pressure due to the verified disconnect between high enterprise adoption and consistently low realized ROI.
Given the strategist summary, I want to reconcile the data points we've gathered. On one side, we have enterprise adoption rates up around 88%, a sign that AI isn't just a niche play. On the other, we see about 73% of projects failing to deliver ROI, which suggests a value gap. The key variables now seem to be how quickly that ROI gap closes, how much capital continues to flow into AI, and whether regulatory or economic shifts constrain deployment. My confidence remains moderate. The sensitive factors are whether enterprises improve their ROI metrics, whether capital markets remain tolerant of high valuations, and the pace of regulation. In short, we're seeing broad adoption but shaky value realization.
Analyst and strategy. Your convergence on sustained deflationary pressure concedes the ROI chasm but soft pedals the real fracture. Fresh data verifies 88 to 90% adoption claims from McKinsey and Deloitte, yet MIT's Project Nanda pegs 95% of Gen AI pilots at 0 P&L impact, with Gartner forecasting 60% abandonment by year-end due to data woes. NVIDIA's PS has decompressed to 20 times amid 2026's sharp pullback, but headlines from Gurley and Fortune scream hyperscaler capex cresting 370 to 500 billion with bubble warnings, as off-balance sheet leases hit 660 billion and utilization lags. Sustained deflation assumes graceful adjustment. This setup risks a disorderly capex cliff if recession bites. I'd call it closer to burst territory unless big tech monetizes fast.
Weighing the final arguments, the Council converges on a nuanced assessment. We acknowledge the analysts' evidence of widespread adoption, validated by recent surveys. However, the challengers' critique regarding critically low returns on investment and potentially unsustainable hyperscaler capex introduces significant volatility and a risk of disorderly correction. The Council's confidence is moderate. All three roles converge on the final assessment that the AI market faces significant volatility and continued correction.